We'll be talking about some basic valuation concepts today for those who are interested in understanding how a business is typically valued. This video is entirely optional. If you have no interest in valuations, please skip ahead to the next video. Let's start with what the value of a business actually represents. The value of a business, or the amount someone is willing to pay for the business, is a function of how much an investor think they will be able to get out of the business in the form of distributions. When you think of how distributions is produced from a business, it's useful to think about the profit and loss statement. A business earns revenue, it pays expenses, leaving you with an operating profit, or what is called earnings before interest, tax, depreciation, and amortization, EBITDA for short. Then the company makes investments, the cost of which is smoothed through depreciation. If the business has any debt, it will then pay interest and principal on this as well as tax. What is ultimately left is attributed to the owner as net profit after tax. Bear this in mind when we go through these various valuation concepts. We will be looking at three of the most popular valuation methods used in finance, namely revenue multiple, EBITDA multiple, and discounted cash flow approach. Let's start with revenue multiple. This is simply a 12-month look at the revenue of the business and multiplying it by a certain number. Now, if you go back to our P&L, if investors are concerned about how much money they're getting, why do they just look at revenues and not the bottom line? The answer is revenue multiples are easy to understand and calculate, less volatile than other measures. Companies may be profitable one year and not profitable the next year without similar swings in revenue. And lastly, revenue multiples are suitable for non-profitable businesses such as early startups. Next, let's look at EBITDA multiple. As its name implies, it is multiplying the annual EBITDA number of the business. This is further down on your P&L compared to your revenue, meaning you're able to take into account the expenses of the business as well as its revenue. This multiple is still pretty easy to calculate and is arguably a better indicator than revenue multiple because more direct information is used from the company. This is more appropriate for more mature businesses that have a relatively stable EBITDA line. Publicly traded companies, for example, will often be talked about in terms of their PE ratio, which is very similar to the EBITDA multiple. Now, what the appropriate multiples are differ from industry to industry, with higher growth industries typically having higher multiples. The multiples for startups, for example, will be many times that of a mature company. For small businesses, multiples approach is typically used for their simplicity. The easiest way to find out the most appropriate multiple to use is to find out a recent sale or purchase of an existing business in your industry and how the purchase price was calculated. One other thing to note is because these multiples do not take into account the funding structure of your business, the value they produce is the total valuation for both debt and equity. So to strip out the value for owners, you'll need to subtract your total debt outstanding as well as add back the cash reserves. Let's move on to the discounted cash flow approach. This is quite different to the other two and may be conceptually challenging for those without a financial background. But this is basically looking at all future distributions to owners, after payments for investments, after debt, and converting this cash flow stream into a single value by applying what is called a discount rate to the cash flows in the future. Distributions to owners is not quite the same as your net profit after tax in the P&L due to timing differences between accounting and cash, but it is similar in that it considers both capital expenditure and debt. Now, it'll probably take a few videos to fully cover discount rate and net present value. I'm not going to do so here. If you're interested, there are a lot of resources online which discuss these principles which are central to modern finance. All I'm going to say is the discounted cash flow approach is most appropriate for companies that can forecast their future cash flows relatively confidently. It is probably the most scientific valuation you will get under these circumstances. It is the method of choice for mature industries, and it is also the reason many junior investment bankers work such long hours. However, due to the level of forecasting accuracy needed to make this approach worthwhile, it is often not appropriate for small businesses that face significant uncertainties. That's it for this video. I know I've covered some complex concepts rather quickly, and I'd certainly encourage you to do some research online if you are interested. And congratulations to those that made it to the end of this rather long video. Next time we'll be looking at how all this is applied in the model.